Chapter 22, Corporations, Part 1, presented by Kelly Herzik. Because Chapter 22 is rather long, I've broken it into two parts. In this lesson, in Part 1, we will discuss the steps necessary to establish a corporate entity. We will discuss the characteristics of corporations, corporate powers, the classification of corporations, formation of the corporation, the legal process of incorporation, potential problems with formation of the corporation, and corporate financing. We'll review the characteristics of corporations. We've discussed a lot of the topics on this slide in previous lessons in constitutional law, criminal law, and in business formations, but I think it's a good place to have a nice refresher so that then you can build on these ideas as we move through the chapter. Corporations are a legal entity. In the U.S., thanks to the 14th Amendment and Supreme Court cases interpreting that amendment, corporations are legal entities. They are legal persons under the law and can sue and be sued. Corporations have rights as a legal person and citizen. As a legal person, in most cases, just like natural persons, corporations have certain rights under the Constitution and the Bill of Rights. Specifically, under the due process clauses in the 5th and 14th Amendments, the federal and state governments cannot deprive any person of life, liberty, or property without due process of law. Courts have held that corporations as legal entities have the right to due process of law. Corporations also have Fourth Amendment protections against unreasonable searches and seizures. Corporations also have free speech rights under the First Amendment. And corporations are creatures of the state. State and corporation statutes establish corporate formation. Corporations also have limited liability. Because corporations are legal entities separate from their shareholders, corporations are liable for corporate actions and shareholders only have liability up to their investment. Corporations have free transferability of corporate shares. Shareholders can freely transfer, sell, or gift their corporate shares. Corporations also have a perpetual existence. A corporation does not dissolve when shareholders die or when directors or officers withdraw or die, but rather can continue to exist indefinitely, unless, of course, the Articles of Incorporation provide otherwise. They also have centralized management. Shareholders generally do not participate in management. Instead, shareholders elect a board of directors who in turn select officers to run the day-to-day operations of the corporation. Then there's corporate taxation. Because they are legal entities, corporations have their income or profits taxed directly by both state and federal governments. Corporate income is often subject to what they call double taxation. Corporations can distribute income or profit in the form of dividends to shareholders, but corporations do not receive tax deductions for paying dividends. Shareholders pay income tax on dividends at their personal rate, leading to double taxation. Alternatively, corporations can retain profits, this is called retained earnings, for reinvestment. Corporate investment through retained earnings can increase stock prices, which benefits shareholders when they sell their stock. Then there is the liability for officers and employees. Directors, officers, and employees are agents of a corporation, and corporations are liable for their acts through respondeat superior. Due to the agency relationship, corporations are liable for the torts and some crimes committed by their agents during the scope of their employment. Next, we will discuss corporate powers. Corporate powers come from state law and their articles of incorporation. There are express powers. State laws usually give the following express powers to corporations: the power to have perpetual existence, the power to sue and be sued, the power to acquire property, the power to make contracts, the power to borrow money, the power to lend money, the power to make charitable donations, the power to make political contributions, and the power to establish rules for managing the corporation. Corporations have implied powers from the statement of purpose in their articles of incorporations to take actions necessary to execute express powers. Next, we're going to discuss something called an ultra vires act. If corporations act beyond their express and implied powers, the act is called ultra vires, beyond powers in Latin, and is null and void. This is an old common law doctrine. Most often, corporations commit ultra vires acts when they enter into contracts outside the scope of their powers. These actions are rare because most state statutes allow businesses to incorporate for any lawful purpose, and most articles of incorporation do not limit corporate powers. Recently, courts have allowed corporations to use ultra vires as a defense to contract enforcement when neither party has performed under the contract. Courts will generally uphold ultra vires contracts if one party has performed. Shareholders can sue to prohibit the fulfillment of an ultra vires contract. The corporation or shareholders can sue corporate directors and officers for damages caused by the ultra vires act. The state attorney general can have the corporation dissolved or prevent the corporation from fulfilling the ultra vires act. Again, these are very rare because most state statutes don't limit the purpose of a corporation. Next, we will discuss the classification of corporations. Corporations can be classified as public or private, profit or nonprofit, domestic, foreign, or alien, publicly held or closely held, S corporations, and professional corporations. We will begin with public or private corporation. A public corporation is a corporation created by the government to help administer law, and they often have specific government duties to fulfill. An example of a public corporation would be the Federal Deposit Insurance Corporation, the FDIC, which insures deposits in banks and thrift institutions up to $250,000. Since the 1930s, the FDIC has also served as the receiver for insolvent banks, which are not allowed to file for bankruptcy. In contrast, a private corporation is created by private citizens for any legal private purpose with no government duties. Then there are profit or nonprofit corporations. Most corporations are for-profit enterprises with the goal of making money for their shareholders in both dividends and stock price increases. Nonprofit corporations may make money, but the goal is not to make a profit. Nonprofit corporations do not have shareholders and do not pay dividends or issue stock. The goal of a nonprofit generally is to provide services to its members or the public, such as churches and charities, and they are generally tax exempt under the IRS Code Section 501(c). Next, we will discuss the difference between domestic, foreign, and alien corporations. Corporations are incorporated in a particular state and are considered domestic corporations in that state only. Delaware is the most popular state of incorporation due to its favorable laws and a special court system called the Court of Chancery. It rules on corporate law disputes without juries, which is why it's so popular. For a corporation that does business in multiple states, they must obtain a certificate of authority to do business in any state other than the one it was incorporated in. In states where a corporation obtains a certificate of authority to do business, they are considered a foreign corporation. An alien corporation is one that is incorporated in another country. Examples of brands that are operating as alien corporations in the U.S. include Nestle, IKEA, H&M, Toyota, Samsung, Royal Dutch Shell, and Aldi. Now let's take a look at an example. Suppose a corporation is incorporated in Kansas. That corporation would be a Kansas domestic corporation. If that Kansas corporation also did business in Missouri and Oklahoma, it would need to obtain a certificate of authority to do business in those states and would be considered a foreign corporation in Missouri and Oklahoma. Next, we will discuss the difference between publicly held or closely held corporations. The stock of a publicly held corporation is available for purchase to the public, and there can be large numbers of shareholders who can buy or sell shares with few restrictions on transfer. In a closely held corporation, stock is generally not available for purchase by the public. Shareholders in closely held corporations are usually family members or friends with an active role in the company. Controlling shareholders typically manage closely held corporations. They're usually the officers and the board of directors. Because they are often family businesses, closely held corporations usually have restrictions on a shareholder's ability to transfer stock to prevent outsiders from gaining control over the company. Closely held corporations are also known as close, family, or privately held corporations. While they only account for a small fraction of corporate assets and revenue in the United States, closely held corporations are the most prevalent type of corporation. Next, we will revisit S corporations. S corporations are named after the subchapter in the IRS code that provides for them and are a type of closely held corporation. We discussed the formation of S corps in Chapter 21. S corps must be formed in a state as a domestic corporation and then elect S corp status with the IRS. S corps cannot have more than 100 shareholders, can only issue one class of shares. No shareholder can be a non-resident alien, and only individuals, trusts, and in certain circumstances, corporations can be a shareholder. Partnerships cannot be shareholders. S corporations are taxed by the IRS like a partnership, and they avoid the double taxation of regular corporations. Shareholders report income from an S corporation on their personal income tax return and are allowed to deduct corporate losses from their gross income. In addition, depending on their income level, shareholders can lower the self-employment tax by splitting income into two components, a reasonable salary and distribution of profit. Only the reasonable salary component is taxed at the self-employment tax rate, thus reducing the overall tax liability. Then there are professional corporations. We've talked about them too. If licensed professionals, such as doctors, lawyers, or dentists, want to practice together as a corporation, all 50 states allow them to incorporate, though malpractice actions can still be brought against a practitioner for his own malpractice or the malpractice of those he or she supervises. Next, we will discuss the formation of the corporation. The creation of a new corporation involves two parts: general organizational activities and legal activities necessary for incorporation. We will start with organizing and promoting the new corporation. Promoters and subscribers are responsible for the organization of a corporation. Promoters are ones who begin the corporate creation and organization process. Promoters arrange financing, raise capital, and obtain licenses. Promoters raise capital for new corporations by making subscription agreements with subscribers. They're just investors, in which the subscribers agree to buy stock in the new corporation. Promoters have the authority to prepare the incorporation papers and enter into contracts to establish the new corporation. If disputes arise with these pre-incorporation contracts, promoters are generally liable and not the new corporation, because the promoter cannot be an agent of an entity that does not yet exist. After incorporations, corporations can accept or reject these contracts. However, even if a new corporation accepts a pre-incorporation contract, that does not generally relieve the promoter from liability, because remember, he's not an agent, he's an actual signatory to the contract. A subscriber becomes a shareholder when the company incorporates or accepts the subscriber's purchase offer, whichever comes first. The next step in incorporation is selecting a state for incorporation. Each state has different laws governing the incorporation process and different corporate tax rates. Other factors in selecting a state for incorporation involve how a state's laws and courts treat corporate management flexibility, shareholder rights, the paying of dividends, and takeover protections. Corporations tend to incorporate in the state in which they are located and in which they do the most business. However, more than half of corporations, including more than half of the Fortune 500 companies in the United States, incorporate in Delaware due to the low taxes and favorable laws and courts. Closely held and professional corporations almost always incorporate in the state where the majority of its shareholders live. Incorporation happens in only one state. After that, to do business in other states, the company gets a certificate of authority, and if they fail to do so, the company, and in some states the directors and officers, can be fined for doing business without authority. Next, we will discuss the second part of creating a new corporation, the legal process of incorporation. The first thing that must be done is the selection of a corporate name. All states require that a new corporation have a unique name and indicate in the business name that the entity is incorporated. It has to be done in some fashion. A state has ultimate approval over the name chosen by a new business. So, who does the incorporating? Well, they're normally called incorporators. This is an individual or group of individuals who apply to the state for incorporation on behalf of a company, and they sign the Articles of Incorporation. The Articles of Incorporation themselves are a key document in the corporation formation process. They contain basic information about the company, they are filed with the state, and it governs the company upon filing. A corporation's Articles of Incorporation usually must include at least the corporation's name, the name of the registered office, the name of the registered agents at such registered address for service or process, and the names and addresses of the incorporators. Incorporators must execute and sign the Articles of Incorporation, file the document with the state, and pay the required filing fee. The state will then issue the Certificate of Incorporation, which certifies the company is incorporated and authorized to do business in that state. Now, I've listed the general items of what must be included in an Article of Incorporation, but in Kansas, the Articles of Incorporation also must include, in addition to the ones previously listed, the mailing address of the corporation for all other mail except service of process, the nature of the business or purpose to be conducted or promoted. It shall be sufficient to state that the purpose of the corporation is to engage in any lawful act or activity for which corporations may be organized under the Kansas General Corporation Code. It also must include the number and types of stock to be issued, their par value, and if there are special rights or limitations on any class of stock, or in the case of a nonprofit, a statement that no stock is to be issued. And if the powers of the incorporator or incorporators are to terminate upon the filing of the Articles of Incorporation, then you must provide the names and mailing addresses of the persons who are to serve as directors until the first annual meeting of stockholders or until their successors are elected and qualify. Next, we will discuss the first organizational meeting. After the Secretary of State issues a certificate of incorporation to a new corporation, the next step is the first organizational meeting. At that first meeting, the shareholders meet to elect the corporate board of directors, pass corporate bylaws, and carry out other necessary corporate business. In some cases, the shareholders name the board of directors before the first meeting and list the board of directors in the Articles of Incorporation. In that instance, the board of directors runs the meeting rather than the shareholders. At the meeting, the corporate bylaws are adopted, which are the rules and regulations that govern a corporation's internal management. The Articles of Incorporation determine who has the power to amend the bylaws after the first meeting, shareholders, directors, or both. Sometimes there are potential problems with the formation of a corporation. Errors can happen. If the promoters or incorporators make an error or omission during the formation of a corporation, a court may rule that the organization is not a corporation, making it a defective corporation. Shareholders may be personally liable for a defective corporation's actions, which can be disastrous. So how do you respond to a defective incorporation? Well, depending on the seriousness of the error, courts may disregard an error in the Articles of Incorporation by recognizing the corporation as a de jure or a de facto corporation. De jure means lawful in Latin, and de facto means in fact in Latin. A de jure corporation is one that has met a state's mandatory statutory provisions and has received its certificate of incorporation. Courts generally hold that corporations that make only minor errors in the incorporation process still enjoy de jure status. For example, a mistake in the address in the Articles of Incorporation would not revoke de jure status. No party can question a de jure corporation's status as a corporate entity in court. A de facto corporation is one that has not substantially met the requirements of a state's incorporation statutes, such as failing to file the Articles of Incorporation. That's a huge mistake. If there is a serious error in the incorporation process, courts can still recognize an organization as a de facto corporation to avoid unfairness to third parties who believed the company was incorporated. For a court to hold a company is a de facto corporation, there is a two-part test. The promoters, subscribers, and incorporators made a good faith attempt to comply with the state's incorporation statute, and the company has already conducted business as a corporation. Only the state can challenge a de facto corporation's existence as a corporate entity. Now, courts can do something called creating a corporation by estoppel. A defective corporation that has conducted business with a third party who relies on the representation that the company is incorporated to his detriment cannot defend against a lawsuit by the third party by claiming it is not a corporate entity to escape liability. In these cases, courts will hold that the company is a corporation by estoppel, meaning the company is estopped from denying corporate status. However, a ruling of corporation by estoppel does not remedy the incorporation error that was made in the beginning or give the company corporate status for conducting future business. Now, it is possible to fix mistakes in the filings, such as name misspellings or error in the address, for example, by filing articles of amendment, sometimes known as a certificate of amendment, with the Secretary of State. In Kansas, if a company needs to amend their Articles of Incorporation, they do so by filing a certificate of amendment with the Secretary of State. A registered agent change, stock change, or name change generally requires an amendment, but a change to the address could be made when the annual report is filed. A change to the corporate directors or officers should also be made with the annual report. So there are some times when you actually don't have to file a certificate of amendment, you just have to correct it as you do the annual required report. However, depending on the powers of the board, any change may require a board vote. It really depends on your Articles of Incorporation and your bylaws. If a corporation makes a significant error in incorporation and is not a de jure or a de facto corporation, and corporation by estoppel does not apply to the situation, courts usually deny the entity corporate status, which deprives shareholders of their limited liability. And as I said, that is a major disaster and lawsuits ensue. Next, I want to discuss a legal concept called piercing the corporate veil. In some cases, courts will deny limited liability to a corporation and will allow a plaintiff to pierce the corporate veil to reach the assets of shareholders. Remember, personal assets of shareholders are generally protected. And it's because those shareholders have used the corporation to engage in illegal or wrongful acts. Courts will not allow defendant shareholders and directors to hide behind the corporate limited liability veil to shield themselves from personal liability for wrongful acts. To pierce the corporate veil, a plaintiff has to generally prove the following elements. The corporation lacked adequate capital when it was initially formed. Usually they're seriously undercapitalized. There's just not enough money in the corporation. The corporation did not follow statutory mandates regarding corporate business, such as failing to follow corporate formalities, failing to have meetings, for example, failing in record keeping or commingling of funds. The shareholders' personal interests and the corporate interests are so commingled such that the corporation has no separate identity. A lot of times these aren't really run as a corporation, they're really run as a partnership or sole proprietorship. Shareholders attempt to commit fraud, wrongdoing, or injustice through the corporation and then try to hide behind it. The last topic we're going to cover in part 1 is corporate financing. Corporations, like every other business, need a source of funding. Corporations most commonly obtain financing by issuing and selling corporate securities. Corporations can issue debt securities, which are bonds and represent a loan to the corporation. Corporations can also issue equity securities, which are stocks and represent ownership in the corporation. Debt securities, which are bonds, are usually long-term loans on which the corporation agrees to pay interest until a set maturity date when the face value is repaid. While the bond is outstanding, the corporation usually pays bondholders fixed dollar interest payments on a scheduled basis. Bonds are sometimes called fixed income securities. Equity securities are stocks, either preferred or common stock. Preferred stock is stock that conveys preferences to its holders with respect to assets and dividends. These are also known as preferred shares, usually with several classes of shares. Preferred share owners usually receive a percentage of dividends associated with the face value of their preferred stock. Owners of preferred stock are paid dividends before dividends are paid to owners of common stock. Some corporations limit preferred stock owners' voting rights. Common stock is corporate stock that does not convey any preference to the holders. It's also known as common shares. Its holders own a portion of the corporation and are paid dividends in proportion to the number of shares owned. Holders of common stock have the right to vote in corporate elections, 1 vote per share, though some corporations use cumulative voting to increase the influence of owners of small numbers of shares. Common stock owners are paid dividends last, after creditors and preferred stock. This is the end of Chapter 22, Part 1.